Well, hello and welcome to the Mutual Fund Show. I'm your host, Niraj Shah. And over the last 3 weeks, we've tried and done the different facets of what to do when you're investing in mutual funds. Remember, viewers, we started off with talking about what are the basic things that you should keep in mind while investing in funds, then how to choose a fund, more importantly. Then we also came to how to monitor the performance of the fund and the exit thereof. And then I thought to wrap up that what we would love to call a series, be really important to have a broader set of the do's and don'ts when it comes to mutual fund investing, especially in the current scenario. And therefore, two guests who join me today to speak about their assessments of the key do's and don'ts, Vishal Dhawan and Anant Ladha, both of them with us on the show. Gentlemen, both of you, good afternoon. Thanks for joining in. Vishal, it can be a very broad brush thing and I will go to the individual things, but just a key thing which you believe people make a mistake while doing their investments or monitoring, and they shouldn't. And then we'll come to the individual facets, of course.
So I think the biggest thing that we come across, especially in recent, is trying to treat mutual funds like a trading instrument, very much like they buy equities, and they want to come in and go out of mutual funds as if it was a stock, without realizing that this is actually the job of the fund manager, and he's doing this on a daily basis. So I think it's important to keep in mind that a mutual fund is an investment vehicle, not a trading instrument.
Okay. And then same question to you.
I feel one of the biggest mistake which any investor can do in mutual fund is giving too much importance to the recent returns. When they see good returns in gold, they try and run after gold funds. When we see good return in equity, we try and chase equity. When we see good returns in long-term debt products, we feel that now it is perfect time to use debt funds, and we try and run after the debt products for that matter. I feel recency bias is one of the biggest mistake which any investor can do in complete investment life as a whole.
Okay, so that's the one key thing. Now let's move on to the do's and don'ts. And there are about, 5 points each that both our guests have given. Maybe some of those could be common points as well, but nevertheless, let's get started. Vishal, the key do's for a mutual fund investor, you are saying look at the mix of your portfolio before adding any sectoral ETF or funds in the portfolio. Why do you say this? Do you see this? Do you see investors doing this quite frequently?
Yes, we actually find that it's quite common to find sectors that come in and out of favor. And what a lot of investors do is they try to supplement their broad, diversified equity exposure with additional exposure to sectoral funds, without necessarily realizing that their fund manager might actually be doing the same thing when he's constructing the rest of his portfolio. So fairly simple example is banking and financial services. We all know that the banking and financial services sector is actually a very large contributor to the index itself. It makes up anywhere between 33 to 35% of the broad indices. And we saw what happened a few months ago when this sector was in favor, that people bought sectoral funds on top of that, which were also banking and financial services, and therefore ended up with a portfolio which may have been very, very overweight on that sector. And therefore, effectively their portfolio returns were dictated on how that one sector did or did not do, rather than have a truly diversified portfolio.
Okay. The other bit, of course, Vishal, that you say in terms of do's, which is focusing on cost. And I was curious to understand that. Lower expenses would obviously mean higher returns. But if somebody's seeking the help of an advisor, people might just get confused because people would believe that direct investing would be low expense versus having an advisor would be high expense. So do you mean that, or are you recommending it in some other way?
So essentially what happens is, one of the things that obviously you would have covered on your previous shows is that mutual funds are not just about equity. There's also debt in there. And what tends to happen with debt is that the amount of potential return is much lower as compared to what an asset like equity can deliver. And therefore, if you don't keep your costs of the debt fund under control, you could end up finding that you end up buying something just too expensive, and therefore don't end up getting net returns which are high enough. Very similarly, if you buy index funds which are low cost, you could end up having a good outcome as well. So the way we look at it is, in trying to chase past returns, don't forget that cost going forward is a very, very important indicator, and actually one of the few controllable things you have as a mutual fund investor when you try to think about how will I generate returns on my portfolio going forward.
Okay. Thanks for that, Vishal. There are some other points to which we'll come, but Anand, just getting you on this, the do's part as well. And the first of the points that you're mentioning, yeah, I've heard pros and cons for this goal-based investing or goal-based planning. Now, why do you recommend this?
See, I personally believe that without having a goal, investing, it is like going on a war without having a goal plan, without having a strategy. I know it is very easy to say that goal-based investing is very easy. I know it is easy, but it is not simple to apply. We have to be very sure that we have a proper goal-based investing in mind. Secondly, without investing without a goal is like going on a walk without knowing the final destination. So the initial step and the first step of any financial plan has to be a goal planning. And goal planning is required not just because I am saying it or not because someone else is saying it, but goal planning is required because every investor needs it. It's the need of the hour for every investor. It is the starting point which we have to take care of.
Okay, so that's part one. And well, Anand believes that invest with a goal in mind. Just wondering, because I believe that a lot of people say that too. But Vishal, can I ask you a cross question on this? I mean, would goal-based investing really work all the time? Because a lot of people say that. I mean, or one of the views is also that if you invest with a goal in mind, once the goal is reached, you would actually take off the investment as opposed to staying put in what could actually be a well-performing mutual fund scheme.
Well, that is a risk that you run because effectively, it ultimately boils down to market timing and being successful and being able to get in and get out of an asset class at the right time or the wrong time. But I think it's good to look at this, just from the year of 2020 as a classic case. So if you look at the year 2020, let's assume that you had a financial goal that you needed to achieve in the middle of the year. And we got into 2020 in an environment where the general view was that India is on a recovery path. And as you reached June, you had an event like COVID come in, disrupt, do all kinds of things to businesses, and of course, create lots of panic in the stock market as well. Now, if you had this goal come up in June, ideally what you would have been doing is somewhere last year itself, you would have started to move some of your money away from equities to be able to control that risk. And you could have reached June of this year and found that you have most of your money already kept aside for the goal so that you don't have to worry about what happened to the stock market. So I think as a use case, 2020 has been an excellent example of why goal-based investing works well, provided you follow it in a very disciplined manner.
Yeah, and well, there are enough and more people who actually swear by that phenomenon as well. Maybe it's actually an incentive to stay invested even during the tough times. So in that case, it could actually work in a positive, in a much bigger positive fashion than not doing it that way. Anand, your second point is mapping the right investing to right time horizon and right asset. I mean, what do you mean by this?
I basically mean that it is also somewhere linked to goal-based planning. So, for example, if our goal is in near term, we have to map it with a debt product or a liquid product for that matter. And if our investment time horizon is more than 10 years, then only we should go after equity. So if we don't have that goal in mind, we really don't know that whether we should use a debt product or an equity product or which is actually the right asset class for an investor. So what I have seen is many of the investors have their money parked in maybe FDs or a fixed instrument type of products. These are investments which are there for maybe around 10 years or 15 years. And they come to equity share market to become millionaires or maybe billionaires overnight. So this is something which we have to take care of. Everything which we invest has to be based on a time horizon, which we have to decide before investing. And we have to make sure that we are sticking to that time horizon during the complete cycle of investment.
Okay, I guess which is why your point number 3 is giving it time, because time is your best friend. But the interesting bit is also the consistency in mindset and investment. Now, what do you mean by this, Anand?
Consistency in mindset means a simple thing. When we start investing, we have a time horizon of maybe 10 years or maybe 15 years for that matter. But whenever there is correction in equity share market, no, our time horizon gets shifted from 15 years to 15 days overnight. Even we don't know that we are shifting our complete mindset. For this, I'll again try to put one point in Indian space or an Indian equity share market or an Indian investment lifestyle. Every investor is a loss averse investor. They are ready to take some risk, provided that their investment or their portfolio is not in negative. This is one point which we have to take care of, so that their consistency in mindset is always there, and they stick with their time horizon, and to ensure that their complete portfolio doesn't go negative, or maybe even if it is going negative, there's a slight justification, and they have a portfolio behind debt portfolio which is taking care of their volatility part. We have to make sure that every investor have a good amount invested in debt fund, and proper asset allocation is followed, keeping his goal setting in mind.
But Vishal advises, of course, that avoid chasing yields in a debt fund and look at the credit quality carefully. Vishal, this advice couldn't be more true, especially in the last 2.5 years. But can you tell us, Vishal, how do people go about doing this? Because an average retail investor, let's say if he doesn't have the support of an eminent advisor or a good advisor, how does she or he go about doing this?
Yeah, so this is again a very good time to talk about this, because we are now seeing yields on high quality debt funds being very low. I think most high quality debt funds would have yields anywhere between 5-6% and nothing beyond that. And for most investors who are today looking at debt mutual funds, there is a desire for a higher yield, because it seems very much in line with what are already low fixed deposit rates, for example. The way that we've always looked at this is that you only get a higher return because you're willing to take a higher level of risk. And unfortunately, most debt fund investors are not really seeking higher risk when they're using debt funds in their portfolio. They're more looking like they want the same level of risk as a bank deposit, but they want a higher rate of return. So our view has been that the way debt funds work is they work for investors in two manners. One is that if interest rates go down, they tend to have the ability to give you some capital appreciation. And in a developing economy, you would find that over a long period of time, interest rates do tend to trend downwards, even though it's not a straight line. And the second thing that always happens is that for a lot of investors who are on higher tax brackets, debt mutual funds are very tax efficient if you hold them for more than 3 years. So the way that we look at a debt fund investment option is that don't chase the yield, because the yield will come with higher risk. Look at AAA, AA, A ratings. These are all published in the fact sheets, but that itself may not be good enough. A YTM, which is published on the portfolio, plus the expense of that fund, normally is a very good indicator for investors to understand what kind of risk they're taking and whether they're comfortable with that risk or not.
Okay. Vishal, you also advocate having a good mix of active and passive strategies. Can you elaborate a bit on that point?
So there's always been this debate over many years that India is actually an active investing market where information arbitrage and asymmetry exists. And passive works very well internationally, but doesn't work so well in India because of the information arbitrage. Now the data, very interestingly, does seem to show that for certain categories of mutual funds, especially large cap, for example, most active managers are not able to beat passive managers. And this has got accentuated once the measurement started to move against a total return index. And it's also got accentuated as expenses on passive funds have become very, very low, and active funds have still been quite expensive. So the way we look at it is, ultimately, when you look at a portfolio, you need to have a combination of what we believe are core market kind of strategies, where you just want market exposure and want to get returns which are equivalent to what the market delivers. And then you want to have some satellite or tactical strategies where you try to get a higher rate of return. And therefore, when you combine active and passive strategies, you're able to achieve both these objectives very, very well.
Okay, so well, as how do I say it? As contrarian as it may sound, if you will, that in a market, as Vishal rightly said, has been always spoken about as an active manager's market, maybe having a mix of active and passive might not hurt. Maybe having a mix of active and passive within India, and then maybe passive on the global side also might not be a bad idea. Okay, point number 5, Vishal, to you, and then I'll get to Anant, is you recommending treating the mutual fund investment as an investment instrument. I think this is the point that you started off the conversation with as well.
Yes, I think it's a very, very important point, because I think a lot of people, especially with the proliferation of ETFs, have started to use a lot of mutual fund instruments as vehicles where you can participate in an upward trending market for a short while and then exit. And especially in products where exit loads are low or the exit load periods are short, there is a greater tendency to do that, because somehow the messaging that a lot of retail investors get is that this is short-term as in strategy, because the exit load is only for a few days or a few months or maybe a year. And nothing could be further away from the truth that ultimately, if you are going to be using equity as an underlying instrument, the need for remaining long-term in that instrument is absolutely critical. And therefore, we need to remember that if you want to do any sort of trading, which anyway we think is a very, very risky strategy for retail investors, if you need to do that, do it with a select set of stocks, do it with a very small amount of your capital, understand the risks involved, but don't convert a mutual fund into a trading instrument.
Yeah, it's very important. And Anant, you saying that while you don't, and I'm sure you agree with what Vishal is saying, but you have a view that if an index fund, for example, comes off by 20-30% or 30% is the number that you've given, then people should do a lump sum investing. Doesn't that do? I mean, that would not be a norm, right? You'll probably need to study the fundamentals of the sector before you decide to do that.
Yeah, absolutely right. We have to study the fundamentals. But there is one thing which I want to point forward. Every time there is a correction, we feel that I will do bottom fishing. Let market correct some more, then I'll put some lump sum investment. Whenever market is correcting, everyone knows that there is an opportunity out there. But how many of us are able to actually crystallize it? I really doubt that thing. So for that, we need a rule. Rules always work. Emotion never works. What happens is when we have rules in place, we always make sure that we are following that rules. One such rule can be whenever index is following 30%, 30% correction will always come whenever there is some severe bad news in the market. So obviously there are chances of market correcting more, but we do not know what is the bottom of the market, like what just happened in March. But as a rule, if we have a rule in place that whenever market corrects by 30%, I'll try and put some lump sum amount. It will completely depend on person to person what amount of lump sum he or she is putting. But some lump sum amount can always be placed whenever there is a 30% crack in the major index. Maybe like if Nifty is correcting by 30%, obviously there is some big reason because of which this correction is coming, and there is a lot of fear in the market. At that time, it is really not possible to invest if we don't have our rules in place. So one such rule which I always follow is, and which I always suggest everyone to follow, is have a strong conviction on growth story of India, on the equity market of India, and make sure that you invest some amount of lump sum whenever there is a 30% correction in equity share market.
Okay, well, we have done about 15-20 minutes, so the do's were very important. We'll try and give a quick perspective on the don'ts as well. I think there are a couple of common points here, and I'll come to you first, Anant. Not giving too much of importance to the recent returns. I think that's probably the cardinal sin that most people tend to commit quickly. Do a large proportion of your clients do that too?
This is one point which every investor tend to do in his or her investment life. For example, I am a big follower of equity markets, and I always suggest that some allocation should always go into equity funds. But I don't want investor to allocate equity funds just because it has performed in last 4 months or 5 months. Seeing a short-term time horizon and deciding on the basis of short-term time horizon is one mistake which many of us tend to do. The same mistake was committed while investing in gold. When gold has already given over 60% return, many investors were trying to chase gold and thinking that it will continue to give this 60% return lifelong. We have to understand that whatever return an asset class gives in long term, it is the return which is probably possible in next few years versus emotion always says that what has happened in last 1 year will continue to happen. will continue to happen forever. We have to make sure that we do not do this mistake and this recency bias.
Yeah. And Vishal, there is a relevant example of GSEX that you're trying to say that, right? I mean, in part, it is a similar point that you're trying to make, the historical performance being made the basis.
Absolutely. In fact, it gets even more complex when you look at things like government securities, because first of all, there is already a tendency for investors to want to be in instruments that they perceive as very safe. And when interest rates fall like they have in the last a few quarters, and the returns tend to be very, very strong as a result, there is a tendency to go overweight on instruments like GSEC funds, for example, without realizing that interest rates may not fall in the same manner going forward, or in fact, even maybe head upwards. And in that case, the same instrument which is perceived as very safe actually starts to deliver negative or low returns. So I think it's important for investors to understand that investing using a review mirror is not a great idea. It's good to get a sense on what has happened in the past, but it's important to look forward and make those choices.
Okay, let's get that plate on. The point number 2 is also pretty interesting. Vishal, I'll come to you. And you're saying don't give excessive weightage to the personality or brand of MFs. What do you mean by this?
So I think most people tend to buy products basis brands. And therefore, they may have comfort with certain, for example, bank brands, and therefore, want to buy investment products from, any of those bank brands that they're more familiar with. Or they may find that there are some brands that, are from overseas, which they might feel that, because it's from overseas, maybe it's better. Or in certain cases, people might feel that something that is local is actually better. In our view, none of that actually is important. I think what people have to get into is understanding what is the process that gets followed at a particular mutual fund level. What's the kind of philosophy that's getting followed by a particular fund manager managing a particular scheme? And do they agree with that philosophy or not? For example, there might be a fund manager who follows a value style of investing, which means that he's very patient. He buys stocks which are at a discount to their intrinsic value and is happy to stay invested for a long period of time before that stock reaches its fair value. Now, if as an investor you are quite the opposite, where you want to participate in high growth stories, you might find that there's a big mismatch between the philosophy and the process that that fund house or fund manager follows versus what you expect. And therefore, just picking the fund on the basis of the brand may actually give you very suboptimal outcomes.
Okay. Well, pertinent point. Now, Anant, amongst the don'ts, you already spoke about recency returns. The other bit is setting wrong return expectations. Care to elaborate a bit on that? We have about 2 or 3 minutes left, gentlemen, so let's make it a bit quick.
See, I basically always believe that we should always have a realistic returns in mind. And whenever we are investing in equity, especially, we have to make sure that we set that 12% returns in mind. But at the same time, we have to make sure that this 12% won't be coming on an yearly basis like it comes in a fixed deposit or in a debt fund. There'll be volatility throughout this complete cycle. There'll be years when there are super good returns versus there'll be years where there are underperformance in any of the mutual funds. So we have to always be ready for this volatility, especially when we are investing in equity. At the same time, we have to make sure that we are investing in debt and not ignoring debt as a whole, because that will give stability to our portfolio.
Got it. Now, I won't mention this overreaction to corrections point because Anand briefly has already touched upon it, that if there is a correction, then invest into it and don't get out of it. But Anand, last 2 points of yours, which is the herd mentality, which people typically tend to do in stocks as well as probably funds, and the reality of following blindly the reality of 100 minus age rule. Can you talk about point number 5 in particular?
See, there's a very, very famous rule which everyone kind of follows, that 100 minus your age is the amount of equity exposure which you should have. I really don't agree with this rule. Suppose there's a 30-year-old young champ who has a home loan and who has even committed to some debts, short-term debts which he has taken, and then he is investing 30%, 70% in equity. I really don't think so that it is relevant for him. goal planning, financial planning is something which is very personalized. When it is personalized, we can have some basic general rules, but generalizing asset allocation can be very dangerous and very harmful to long-term investing. And second last point was the herd mentality. I don't want investor to come into mutual fund and invest just because nowadays he or she is hearing everywhere that mutual fund sahi hai. He has to himself assess that whether a product is useful for him or her or not. If it's not useful, then they can probably avoid it also. But they should not invest in any of the asset class for that matter, just because their friend are investing in the same asset class.
Okay. Thanks for that, Anand. Vishal, point number 3, remaining invested in an underperformer. I think this happens in stocks as well. You're saying it happens in funds too?
Yes, it happens very often because, when you stay invested in something which is not doing well, mentally you feel that it'll do something going forward. And when you actually exit it, you're kind of admitting that you made a mistake. And most people hate to admit that they made a mistake themselves. So we see this happen very often where people just stay on with an underperforming scheme for a very, very long period of time. I think it's important to set a time frame before which you will reassess that decision. Maybe your exit choice needs to be done after you've done an independent assessment. Maybe you're going to be exiting out gradually, not everything together. But don't just stay invested there because you believe that anything which is underperformed in the past will outperform in the future. There is no such math that is obvious.
Yeah, well, and I think stock investors should also take into account. Vishal, last couple of points very quickly. Number 5, which is defining long-term as 3 to 5 years for equity investing in mutual funds. You are saying it should be longer. And also number 4, which is adopting the same pace of investment in every phase of the market.
Yeah, so I'm just going to talk about number 4 first, because I think a lot of people have believed that an SIP strategy is a relevant strategy irrespective of what's happening in financial markets. And our view is that while an SIP strategy is excellent in terms of discipline of investing and ensuring that you have some sort of investing happening, if markets do end up becoming expensive, for example, a Nifty at a PE of 32 may not require you to invest at the same pace as when the Nifty is at 16 times. So when it's at 16, you might want to invest more. When it's at 32, you might want to invest less. So I think you need to stagger your investment pace depending on how valuations are. As far as 3 to 5 years are concerned, I think this is again important because if you go back in history and look at data, you find that for equity markets to become lower risk investment options, your investment horizon actually needs to be 10 to 15 years and not 3 to 5 years. And on top of that, you see this getting even more complex when SIP investors count their starting date of the SIP and then measure 3 years from that start date, without realizing that their SIPs are actually going in every month. And therefore, even if they've stayed invested for 5 years, their effective holding period for the investment has been only 2.5 years. And therefore, very clearly, I think for most investors, if they're taking equity-based mutual fund decisions, they should be having a 10 to 15-year investment horizon to really be able to eschew and do away with the risk of downside in equity investing.
Okay, gentlemen, I hope these do's and don'ts are taken up seriously by some of our viewers, at least if not all, but I'm sure it's helpful in more ways than one. A bit of a ready reckoner in about 28 odd minutes. Both of you, thank you so much, Vishal and Anand, for joining us today on the Mutual Fund Show.
Thank you very much.
And viewers, thanks for tuning in to this leg of the show, and happy investing.